What is this? What is this? Zero hedge. You mean to tell us there's a housing problem? Mortgage crisis? Again? I thought we got rid of that problem back in '09. Mortgage refis tumble to lowest since the financial crisis, leaving banks scrambling. No wonder why they're charging us all kinds of fees. Cash advance fees just to go buy some cryptos with a credit card. No wonder why they're stopping you from taking your own money out of their bank and transferring it over to the likes of Coinbase and buying some cryptocurrencies. They need money. At the end of March, which, by the way, speaking about the end of March, we're in April now. 71 degrees outside, low of 55 degrees. Tomorrow, low of 62. April, midway through April 20, forget the year. The year is not important. I'm in Florida. Pablo, honey, please come to Florida. You washing your ass, keeping self clean, honey? Jerky boys. I do miss the Jerky Boys. Me and Steven always crack Jerky Boy jokes back and forth. Hi, this is Saul. What is your name, sir? Saul. What's your name? Saul! Damn you. He said we could walk on the beach together and step on piss clams and... You gotta love the Jerky Boys. If you don't know what the hell I'm talking about, just go to YouTube, which you're already on, and search for Jerky Boys. Saul Rosenberg, S-O-L. Saul Rosenberg is one of them. You'll get a kick out of it. Oh, suddenly, all of the sudden, mortgage refis. Oh, that would be fun. Jay Snip, do an entire Zero Hedge article in the voice of Saul Rosenberg. At the end of March, we penned that the bank sector is in peril as refi activity crashes amid rising rates. And since then, it has only gotten worse. According to the latest Mortgage Banker Association data, mortgage demand continued to slide. I can't do it. Mortgage demand continued to slide, and last week, mortgage application volume slumped another 1.9% week over week and minus 5.5% year over year, despite a modest dip in rates. And while initial purchase applications dropped 2%, it was the minus 1.7% drop in refis, which followed a 4.9% drop the previous week. That was once again the biggest concern, as it plumbed to levels not seen since, you guessed it, the fall of Lehman Brothers in nearly a decade ago, 2008 and 9. The reasons for this collapse are all too well known and were covered here 2 weeks ago, and they link to themselves on Zero Hedge. With interest rates materially higher than they were a year ago, and lending conditions still relatively tight, there is less incentive for borrowers to refinance. As Diana Olick pointed out, for those who want to take cash out of their homes, more are now turning to second home equity loans rather than refinancing their primary mortgages and subsequently losing their rock bottom rates. This picks up on what we said last month. And here's the other thing. Wait, whoa. Why the hell are y'all getting refis again? Did we not learn last time you don't do the refi? Or maybe you do the refi because you're realizing the party's over and you're going to be underwater in your mortgage again. So you fixing to get yours. I'm going to get mines, right? Give me my money. Foreclose, walk away, have a nice day. Banking collapse 2.0. You could almost see it repeating, can't you? Can't you? This picks up on what we said last month, namely that anyone who could and would refinance already has, while the universe of those who have not yet to take advantage of lower rates and are eligible to do so has collapsed, as Black Knight pointed out in its latest Mortgage Monitor report. What is peculiar is that the latest weekly drop in mortgage apps, short for applications, whether purchases or refis, took place as the average interest rate for 30-year fixed-rate conforming mortgages decreased to 4.66% from 4.69%. Not that that's, from fraction of a percent. Not really anything to write home about yet. But it means that potential buyers who are less sensitive to weekly rate moves are either not enticed by what they're finding on the market this spring, or more than likely, they can't afford it. Bingo! Not that they missed it or not really liking. Nope. They can't afford it. However, as Oleg notes, the drop is surprising, given that this is the heart of the spring housing season, and a stronger economy would suggest higher demand. Sentiment for buying, however, has been volatile, falling sharply in February and then bouncing back in March, according to a monthly survey by Fannie Mae. It's a survey. That's interesting. Why would you choose to do a survey, Fannie Mae, if I may ask? Don't you guys have the hard stats? For God's sakes, you're Fannie Mae, Freddie Mac, you know those guys, those old chestnuts. We're going to do a survey. No, how about you just crack open the books and tell us what you guys are seeing? Nah, oh no. You don't want to see that number, my friends. We're going to do a survey, and we're going to pick the cream of the crop. March was great. Oh, March was great. Kind of like this. Hey, Democrats are not. No, hold on, back up. Polls show that Hillary Clinton's going to win 60 to 40%. Really? How many of those polls were Democrats out of 1,000? 700. So 300 were Republicans. Yeah. And that's your poll result. Yeah. Quick look surprised. Like, okay, yeah, makes sense. Sure. That or perhaps the economy is not stronger. Another potential explanation is that buyers may have been spooked last week by exceptional volatility in the stock market due to the potential for a trade war with China. Most likely, however, they are turning away from what has become an extremely pricing housing market. Something we covered overnight in Economists Who Push Inflation, stunned that rising home prices put buyers deeper into debt. Another article they had, of course, at Zero Hedge. And as Oleg adds, when an early spring market is this lean and this expensive, some buyers choose to wait until later in the season, hoping to wait out the crowds and find a better deal, which is bad news, not only for the homeowners, but also for the banks whose refi pipeline, a steady source of income and easy profit, how can they put this lightly, is about to vaporize. Good word. However, while exorbitant prices are bad for homeowners who are unable to afford a home, the collapse in refi activity is murder for the banks, whose refi pipeline, a steady source of income and easy profit, is about to vaporize. So hold on. They wrote that twice. They actually wrote it twice. Here are some more details from the Wall Street Journal. Last year, 37% of mortgage origination volume was because of refinancings, according to industry research group Inside Mortgage Finance. That is the smallest proportion since 1995. And the number of refinancings is widely expected to shrink again this year. In 2012, refinancings were 72% of originations. And I had somebody contact me not that long ago. Joe, wish I could just grab the email. I don't know if I've already deleted it or what, but I said, Joe, you were talking about the mortgage thing the other day, so this is a few weeks ago. You absolutely nailed it. He's like, we're responsible for some million number, $40-50 million worth of mortgage origination, something like that, he said, at his company. He said, Joe, it's not looking good. You were right with that article. I'm like, wow, interesting. But according to Fannie Mae, demand was up back in March, according to a monthly survey. Right. While purchase activity has climbed steadily from a post-financial crisis nadir in 2011, growth in 2017 wasn't enough to offset a $366 billion decline in refinancing activity. The result? The overall mortgage market fell around 12% to $1.8 trillion, according to Inside Mortgage Finance. The market has just gotten so very competitive because every loan matters. Is that like Black Lives Matter? Every loan matters, said Ed Robinson, head of the mortgage business at Fifth Third Bancorp. He added that the bank is contacting homeowners who could be eligible for a refinancing in coming years to help maintain that business. And it is also instructing mortgage loan officers to focus more on purchases. We demonstrated this plunge in bank mortgage financing last quarter, another article, Zero Hedge, linking to themselves, when we showed the near record low mortgage application activity at America's largest traditional mortgage lender, which is, unfortunately, Wells Fargo. Non-traditional lenders face even greater peril. Quicken Loans, Inc. got about 70% of its mortgage origination volume last year from refinancings. Somebody tell me. Go ahead. I need this. I need it. I need it now. More than words can say. I need it now. I need you to tell me that we're not repeating 2005 and 6 and 7 and 8. We're not repeating. We're not going to do all these refinancings. We're not going to do... Oh, boy. People, hope you got your crypto. Hope you've been dumping money into that so that when those things freaking go, you don't have to deal with any of this. You can pay your houses off. You can pay your refi off, whatever you got. Hope you got enough crypto to make that happen. Stake in a room, fellas. That's all we need. A little bit more to this article, but I think you get the point. If you want to read the full thing, we'll absolutely have the link below. Take care.